Dan Davis, President and co-founder of ADK Wealth Advisory Group, Financial Planning World. Welcome, communities. Today's focus is really around the best practice category. When I say best practice, you know that the Financial Planning College for Financial Planning has several different categories. Retirement planning is one of those. The focus today is retirement planning, specifically the transition from the accumulation phase to the distribution phase. The distribution phase, quite simply, is when you start taking money from the savings that you've been having so that you can enjoy the next season of life and not run out of money. So the question that I get very often, either from new financial advisors or from clients who are approaching or just hitting that stage of life, is how do I actually do this? So there's really a merging of two major areas. One is income taxes, and then the other is asset allocation. So I'm going to talk to the asset allocation first because that's the simplest, and then I'm going to come to the taxes after that. So there's a variety of different ways to go about using asset allocation. Most of our clients do not have enough money saved where they can just turn the income on from the assets and that would meet their distribution goals. A lot of clients are taking, call it 4% of their asset pool. And if you look at stocks and bonds, the yield combined is hard to hit that 4% number. So what we do is, if you think about non-volatile assets, it doesn't mean that they can't go down in value. It's just that they're not super choppy. And I would categorize the non-volatile assets as things like cash, money markets would be cash, bonds, but the type of bonds I'm really talking about would be investment grade bonds, not like high yield bonds. So things that are pretty conservative. They can still go down. A year like 2022, for example, bonds had the worst year that they've had since I was a lad in elementary school. So you're talking back in the 70s. But what we do is we set up a systematic that is a sale that then generates cash that then deposits that money directly into the client's account. And then as the stock market does its thing of this or this, during a period where it's going down, we don't want to do anything with stocks other than let them recover. And then as they do recover, that's when we'll do what they call a rebalance, where you take money from something that's done well and replenish that non-volatile asset class. And then you just sort of repeat that over long periods of time. It's more to it than that, but that's the essence of it. On the tax side, when people are retired, that first year of full retirement, maybe not the first season of retirement, because it might be that someone retires in June, and a lot of times they have a half a year's worth of income, so the tax planning is convoluted. But in the fourth quarter of every year, we do what's called as a tax pro forma. And the tax pro forma is really kind of looking at where is your current tax, both your provisional income, your modified adjusted gross income, and your taxable income. Because what we're really looking at is your tax bracket, your Social Security taxation if you're receiving Social Security, and then lastly is the income bracket that you're in for Medicare testing. We'll just refer to that as a means test. It's those three areas that we're monitoring. So as we're taking the income from the non-volatile assets, the ideal is to be able to do that from a non-qualified asset. Let's define a non-qualified asset. It's an asset that's already been taxed. So it's not an IRA, it's not a 401k, it's things like money that you put in the 401k on an after-tax basis, or if you had stock options that you've exercised and now they're in an investment account, or money that you were just saving in an investment account along the way. Non-qualified assets. As we're spending that, since the principal of that's already been taxed, we can spend it and there's no income tax on that. Now, if it's got gain embedded on it or it's paying dividends, that part's taxable, thus doing that tax pro forma. And the idea behind this is that as we're doing that, we're probably positioning you in a lower bracket if you don't have a pension or a large Social Security amount. That allows us, prior to you turning 73, to be doing Roth conversions, paying attention to those three areas: tax bracket, Social Security taxation, and Medicare means test. And it's typically a $20,000 to $50,000 Roth conversion, so they call that a partial conversion. I've never converted someone's entire retirement account. But if you think of it as this, once you hit 73, required minimum distributions that used to be at 70.5 are forced out. So now you have to take a chunk of money, whether you want it or not, and it's taxed. So what we're trying to do is reduce the size of that IRA so that by the time you hit 73, the amount that's being pushed out is less than what it would have been if we just let it accumulate. But we're trying to do that in real time so that we're balancing future tax and current tax based on those three things. There's a whole lot to that. I'm not going to bore you with the details of it, but the real essence of it is spend non-qualified money prior to 73, and then look to do Roth conversions the best that you can. And you're doing tax pro formas to make sure those three areas that we are monitoring, that we don't have an unintended consequence where we move you from, say, the 12% bracket to the 22, or you're in a bracket that allows you to pay no capital gains, 12% or less, if you're in those brackets, and then we bump you to a bracket that causes you to have to pay the capital gains. So it's a nuance. And when we're looking at Roth conversion, the other thing we're looking at is things like tax loss harvesting or taking gains from stock or stock mutual funds. We have many clients that we don't do the Roth conversion for because they're in the 12% bracket, and we can sell gain assets at 0% capital gain, and that's more attractive than Roth conversion. There are times where we do both. There's times where we don't do any of it. That's why we do that tax pro forma in Q4. So in summary, basically asset allocation, tax planning, blend them together for that distribution phase. Do it intelligently, do it systematically every year, and that way you can look at what do we need to do for this potential year and then the year coming forward. And then obviously as rules change, you have to make adjustments. So I hope that's helpful. If that's something that you're interested in learning more about, just reach into the normal channels. We're here to help you out. If you're a financial advisor watching this through Financial Planning World and you have an idea that you'd like to share best practices, you can schedule an appointment through the website with me to do that. If you're a client, thank you very much for your trust. Hope this is helpful in edification on how you actually do that distribution. Have a great day. Signing off from Franklin, Tennessee. Thank you.